My credit score is 628. I've been meaning to fix it for about 2 years. What's been stopping you? Honestly, I don't really understand what fixing it means, or what it actually costs me to leave it where it is. That second part is the more important question. A low credit score isn't just an abstract number. It is a monthly fee, a real dollar amount that you are paying on every loan, every credit product, every apartment application, whether you have ever thought of it in those terms or not. How much of a fee are we talking? On a car loan, the difference between excellent credit and fair credit can be $150 to $200 a month in higher interest charges. On a mortgage, over the life of the loan, it can be tens of thousands of dollars. Your credit score has a line item in your budget, whether you included it or not. I never thought of it as a budget issue. Most people don't, which is exactly why they leave money on the table for years without realizing it. Your credit score is not just a number that banks use to decide whether to approve you for things. It is a pricing mechanism. It determines the cost, not just the availability, of nearly every major financial product you will use as an adult. Car loans, mortgages, personal loans, credit card interest rates, in some states, auto insurance premiums, even landlord decisions about rental applications. The FICO score, the scoring model developed by Fair Isaac Corporation and used in the majority of lending decisions in the United States, ranges from 300 to 850. The higher your score, the lower the interest rate you are offered on borrowed money. The lower your score, the more you pay for the same loan. That difference in cost is not abstract. It shows up in your monthly payment every single month until the loan is paid off.
The CFPB, Consumer Financial Protection Bureau, publishes data regularly on the relationship between credit score tiers and interest rates across major loan categories. For a $30,000 auto loan with a 60-month term, the difference in monthly payment between a borrower with excellent credit, 760 and above, and a borrower with fair credit, 580 to 669, has historically been between $100 and $200 per month, depending on the interest rate environment. Over 5 years, that difference represents $6,000 to $12,000 in total additional interest paid for the same car purchase. On a $300 Zuzo's mortgage with a 30-year term, the difference between a top-tier rate and a mid-tier rate can produce a monthly payment difference of $200 to $400, and a total interest difference over the life of the loan exceeding $70, 00.
These numbers mean something specific in budget terms. A person with a 628 credit score who finances a car is almost certainly paying somewhere between $100 and $200 more per month than a person with a 750 plus score financing the same car at the same purchase price. That $100 to $200 per month, $1,200 to $2,400 per year, is a budget line item that was never written down, never tracked, and never given a category. It simply compounds in the background as the cost of having built credit history that does not yet reflect creditworthiness accurately.
The 5 factors that determine your FICO score are worth understanding clearly because they define exactly what needs to change for the score to improve.
Payment history carries the most weight, 35% of the total score. This is the record of whether you have paid every bill, every loan minimum, and every credit card payment on time. A single missed payment, particularly a payment that became 30 or more days late, can drop a score by 50 to 100 points and remain visible on the credit report for 7 years. Making every payment on time every month is the single highest impact credit improvement action available.
Credit utilization accounts for 30% of the score. This is the ratio of your total current credit card balances to your total available credit limit across all cards. A person with 2 credit cards, one with a $3, zero limit, and one with a $2,000 limit, has 5,000 of available credit. If the combined balances on those cards total $4,000, the utilization rate is 80%. FICO scoring models respond favorably to utilization rates below 30% and most favorably to rates below 10%. Paying down credit card balances or requesting credit limit increases without increasing spending are the two direct levers for reducing utilization.
Length of credit history represents 15% of the score. This measures the age of your oldest account, your newest account, and the average age of all accounts. Closing old credit card accounts shortens the credit history and typically lowers the score, which is why closing a card you are not using is generally counterproductive, even if it feels like financial simplification.
Credit mix accounts for 10%. This reflects whether you have experience managing different types of credit: revolving credit, credit cards, installment credit, car loans, student loans, personal loans. A mix of both types generally supports a higher score than revolving credit alone.
New credit inquiries represent the remaining 10%. Applying for new credit generates a hard inquiry on the credit report, which temporarily reduces the score by a small amount. Multiple applications in a short period can have a more noticeable effect, which is why shopping for credit, particularly auto loans and mortgages, should be done within a concentrated time window when possible, as multiple inquiries for the same loan type within a 14 to 45 day period are typically treated as a single inquiry by scoring models.
For someone with a score in the fair range, 580 to 669, and the goal of moving into the good range, 670 to 739 or above, the practical action plan is specific and achievable within 12 to 24 months.
First, access your free credit report from all 3 bureaus, Equifax, Experian, and TransUnion, through annualcreditreport.com, the federally mandated free access point. Review each report for errors, incorrect account information, accounts that are not yours, late payments that were actually on time. Errors are more common than most consumers expect, and disputing inaccurate negative information is free and can produce meaningful score improvements relatively quickly.
Second, pay every minimum payment on time going forward without exception. Set up automatic minimum payments on every account if necessary. Payment history rebuilds over time with consistent on-time payments. The impact of past late payments diminishes as they age and as the on-time history grows.
Third, work to bring credit card utilization below 30%, targeting below 10% if possible. Paying down balances or requesting limit increases without spending more are the 2 primary mechanisms.
Fourth, if you have no credit history or a very thin file, a secured credit card, where a cash deposit serves as the credit limit, can begin building a positive payment history. Use it for 1 or 2 small recurring purchases per month, pay the balance in full every month, and the account contributes positive payment history and utilization data to the score.
Dave Ramsey's perspective on credit scores deserves acknowledgement here. He has historically argued that credit scores are a measure of debt management, not of wealth, and that the goal should ultimately be to need credit as little as possible. This is a coherent position, but for the majority of Americans who will finance a car, rent an apartment, or purchase a home at some point in the next decade, the cost of a low credit score is a real and ongoing expense that has a direct impact on monthly cash flow. Improving it is not a concession to a debt-dependent lifestyle. It is a reduction in the ongoing fees imposed by a system that prices risk based on credit history.
Your credit score is already costing your budget something. The question is only whether you know how much.
So a low credit score isn't just about getting approved. It's about how much more I'm paying every month on every loan I already have. It's a monthly fee most people never calculated because it never shows up on a line item. It's just baked into the interest rate. Payment history is the biggest factor. 35%. Pay on time every time. And set up auto pay on the minimums so that on-time payment happens even when life gets busy. Utilization under 30%. Under 10 if possible. 2/3 of your score is those two factors alone. Payment history and utilization. Fix those and the score moves. I've been leaving money on the table for 2 years. Most people do. The cost is invisible until you calculate it. Then it's very visible. I'm pulling my free credit report this week. Start there. Errors are more common than people expect. And fixing one can move the score without changing a single behavior.